Hello, everyone. I'm Nikki Sidlow, the event manager at Venture Cafe St. Louis, and we're really glad to have you all here today to learn more about how small businesses can best adapt to the changing market and economy, as well as an investor's point of view for how startups should position themselves for future financing. Our session hosts today are Lucas Donnelley and Jason Ellis. As Dreampact Ventures Managing Director, Lucas is responsible for partnering with portfolio companies to help maximize their impact, managing their due diligence process, and running the day-to-day operations of the fund. Lucas started his career at JP Morgan, where he most recently worked in New York with executive leadership in the wealth management business. Prior to New York, Lucas was an analyst in JP Morgan's St. Louis office. Jason Ellis is the Chief Financial Officer at Ryvit, which is the construction industry's integration platform. Jason is a CPA with an entrepreneurial spirit with over 12 years of experience and leadership in startup finance, financial modeling, software implementation, and more. Venture Cafe St. Louis hosts one of the largest in-person weekly events for entrepreneurially minded people, and now we're hosting talks with experts throughout the week to help you launch and grow your business or idea. Thanks for joining us, Lucas and Jason, and I'll let you take it from here.
Thanks a lot, Nikki. Appreciate it. And thanks, everyone, for joining. Just to kick things off, I was hoping to give a lay of the land for what we're going to talk about and maybe help you start thinking about questions that you want to ask towards the end. But the goal for today is just give everyone a quick update on startup financing trends. So there's a lot going on, as you all may know. I just wanted to give some high-level details and expectations for the rest of the year. Walk through the initial reaction to COVID that we had at Dreampact and that we implemented with all of our portfolio companies. Your companies or the companies of those that you know may be going through that process still. So we wanted to give you a quick overview of that. And then lastly, where we want to spend most of the time is now what? So in this post-COVID environment, or even as we continue to go through this, what are the considerations that you can look at to building a lasting company and taking your business to the next level as we go on? I'm super excited to have Jason on the call. Jason is the CFO at Ryvit, like Nikki mentioned, and it's a portfolio company of Dreampact. We've had a really great relationship, and Jason, as CFO, has actually made a lot of these decisions. He's in on the ground floor and has had to make some tough calls and think about the long-term strategy from an actual startup standpoint. So happy to have him here.
Yeah, great to be here.
Thanks, Jason. And basically, just to start off on a bit of a funny note, there was just this craziness going on in March and April where people were rushing to make difficult decisions. Everyone's watching the news, learning what epidemiology means. And I feel like now we're in this phase where you've already made those decisions. You've gotten the funding, maybe a PPP loan. You've gotten the funding you need to make it to at least the end of this year or early next year. But now we're in this phase where it's really important to think about what comes next. And I really wanted to just give a quick update on what has actually happened so far. The main takeaway, if you look at the data, is that there wasn't a huge shift quite yet by the end of Q1, at least when it comes to early stage startups like angel and seed stage. They were fairly strong overall in terms of volume and valuations, but we're starting to see valuations dip a little bit, and that started in Q2 of 2019. Most of the deals, just a caveat there, most of the deals that got done in Q1, just being on the ground floor anecdotally, were deals that were already in the works. So startups were already building their investor pipeline. They were already kind of close to the finish line, and they were able to get the deal done. I think this quarter is going to be much more telling in terms of valuation. So it's going to be year over year, probably a pretty significant drop, as well as volume, as some people are just waiting on the sideline to see what happens. Pretty stark difference between early stage and late stage. And as you can see, if you look at the average deal with later stage, which is Series C and above, it's pretty crazy. And this is largely due to the SoftBank type deals where they're raising at, $800 million pre-money valuation or in the multiple billions. That's kind of throwing this all off. And later stage is probably going to feel the hit first because they're much more tied to public comparables. So if a public company that they're competing with is trading at a certain valuation, more than likely these later stage startups are going to feel a hit more immediately. And just to look like to the past at what happened in prior crises, the variety of up rounds, the frequency of up rounds this quarter hit an all-time high. Meaning if a company raised at a valuation of 10 million a year ago, they raised something higher than that after that. When you look at what's happening today and comparing that to something like the financial crisis, we should expect a pretty significant decrease in down and flat rounds. So that's just something to keep on your radar and think about, that this may be more common over time. But here's the thing. We don't know what's going to happen. Warren Buffett, I loved that he shared this super simple slide during his annual shareholders meeting. We don't know what's going to happen. It's really hard to predict the future. So the whole point of this talk is that it's crucial to plan ahead. It's crucial to think about probabilities and to prepare for the worst. And that's what we're here to discuss with you today. But before we talk about the future, I just want to give a quick overview of what we did as soon as COVID hit. So this was in February. We were sending constant, sorry, Jason, for all the emails, but many emails to our portfolio companies with updates on what's going on in the business world, lending options, and ultimately we came to this kind of 5-part reaction plan, essentially based on let's survive. Let's make sure we get out of this phase and do what we can to control that and go from there. So, Jason, the 5 items are here, but maybe it would be better for you to explain from Ryvit's standpoint what you actually did and how you were thinking through this as the crisis hit.
Yeah. Thanks for that, Lucas. Happy to do that. Like Lucas said, especially early on, but to a large degree today, even the sort of depth and length of the impact of COVID-19 is still very unknown and very uncertain. So to his point, our immediate focus was on preserving cash and extending runway. There were a lot of opinions being put out there, looking at LinkedIn, there's all kinds of advice from investors, startup CEOs, et cetera, with different ideas and different things that you can be thinking about right now. But the one common theme was, because of the uncertainty, preserving cash, extending runway is extremely important as quickly as possible. There were recommendations to have 12 months of runway left, some all the way up to 2 years of runway left. So that theme was very prevalent and made perfect sense as quickly as possible. So we looked at a number of different specific ways that we could extend our runway, basically to free up some time or give us some time to be able to understand what the true impact of the coronavirus was going to be on our customers, or more importantly, our customers' customers. So we looked at we kind of segmented our view in terms of like what we know and what we can control, and then what we don't know yet and what we can't really control right now. So in terms of what we could control, first place that we obviously looked was our spending. And the team was absolutely off the table. Our team is the most important asset that we have, and being an early stage startup company, everyone contributes a lot. So we looked more at the discretionary spending first. So things like travel and events. Now, not exactly in our control as far as what we spend there, because in later Q1 and so far this year into Q2, all the events that the trade shows, conferences, everything that we've been registered for that drive a lot of leads for us have been canceled. So wasn't necessarily something in our control, but a known nonetheless. Knowing that a lot of companies in general were going to be sort of tightening up their budgets until they understood the impact of the pandemic on their business. We looked at some of the larger, more costly marketing initiatives that we were contemplating and evaluated whether now was the right time to continue forward with those, or could those be delayed until the future when there was a little more certainty. Some of the software tools that we're using was an easy area of focus. We're a software company, so we like to use all the sort of latest and greatest software tools, and I think sometimes that kind of creeps up on you, and you're not really sure exactly who's using what. So we just took a fresh look at those to make sure that we're getting a good return on the investment in all of our software tools. And then things like our hosting environment, always looking to optimize the platform and how it's hosted, but just taking another closer look there as you're an early stage startup growing quickly. That's an area where there might be opportunity for cost savings. In terms of our products, being a marketplace, bringing integration products to market through partnerships, we sort of narrowed our focus in on those products that were already generating revenue. So sort of rallying the team around all of the products that were either very close to being in the marketplace or already in the marketplace, and pulling back on some of that more what you would consider R&D spend. Operationally, looking at our internal processes and communication to optimize our internal efficiency. Again, it's something you're always doing, but in terms of preparing for uncertainty, just putting more focus there. Customer service is a huge one. It's pretty well known that new business and new bookings, there's a lot of uncertainty around those for every company. So one of the best ways to sort of weather the storm or prepare for this uncertainty for us was to really elevate our customer service. I think I've said it with all of the points here, but customer service is always a priority, but certainly now more than ever, making sure that existing customers are happy, that what they're thinking, what the impact to them is on from the pandemic right now is really important. Being transparent with our team, that was one thing that since I've joined the team just under 2 years ago has always been a top priority, and that our team has always appreciated. And we knew that by not being transparent with our team about sort of what was happening, how we're thinking about it, how we're approaching preparing for it, what our priorities are, we knew that would only impact not only their happiness, but their productivity. So from day one, we've been completely transparent with our team and reached out and engaged our board. That's something that we could very much control. We're always very engaged with our board. To Lucas's earlier point, really enjoyed working with him. We talk at least weekly, I would say, but usually multiple times a week. But leveraging their experience, this is uncharted territory for a lot of us. And if you're with an early stage startup company, you probably have some board members that have seen something similar to this, and it's important to draw from their experience. And then, of course, looking at any alternate funding sources, like Lucas mentioned, the PPP, any other debt facilities, if you have any venture debt, traditional lending relationships that you can leverage, that's another place to look. And then in terms of the unknowns and sort of what is beyond our control, it's everything around revenue. So I made the earlier point, what is the impact of coronavirus going to be on our customers and their customers? So in terms of how we approach that, we looked at okay, what's the sort of worst case scenario that could happen? This is where the scenario planning becomes really important. Making sure we're focused on some of those KPIs and constantly measuring those, making sure they're constantly visible to key stakeholders, leadership team, establishing those decision points. So if this happens, here's how we react. If this happens, here's how we react. I kind of liken it, and there's a sports reference a little later on in the conversation, which got me thinking about this, but I liken it to athletic teams, sports teams, practice. I think about, I'm a hockey guy, so I think about it in terms of like practicing our power play or practicing our penalty kill, practicing, dump and change, all these different concepts. And why do we do it? It's so when that actually happens, we can act very quickly. And so that's what we did in terms of the unknowns and some of the things that are out of our control.
Which is a good segue, because what all those things that Jason just talked about happened in the last maybe 2 months. It was crazy. Lots of decisions were made, strategies were set, people were making decisions incredibly fast. But that just gets you through the first wave. That just gets you through kind of figuring out what your runway is going to be, lasting till hopefully certainly by the end of this year and at some point next year. You have you've been there, you bought the t-shirt, now what? So I think one of the keys moving forward that we're emphasizing for our portfolio companies is this concept that Jason was just talking about on scenario planning. So just about every company that we work with and some that we advise have trigger points that if their revenue doesn't come back to X by the end of September, they're going to make this decision. And if their expenses aren't able to drop by X percent by a certain point, they're going to make a more difficult decision on their operating expenses. So I guess from a strategy standpoint, I highly recommend thinking about it that way, having your trigger points as this wears on. We don't know what demand is going to look like, if it'll pick back up to where it was before or better than that or worse than that. Have plans for what's going to happen in those scenarios. And goes without saying, but start from the extremities and work your way in. Like Jason kind of talked about, the team was a non-negotiable. That was the highest priority, is to maintain the Ryvit team, because that's where their strength is as a startup. So they cut subscriptions. Obviously, the event budget was gone, travel was gone, and they cut from the outside in. And I feel like that worked really well for them. And then the third point is that right now it's crucial to make decisions quickly. Oftentimes it's easy to sit on something, mull it over, or just kind of kick it on to the next quarter. But when it comes to crisis planning, you need to think very deeply, think in terms of probabilities, and make your decisions quickly as you go. There's an article I highly recommend if you just Google camel startups versus unicorns. I love the concept. It's something that we've been talking about at Dreampact a lot. When you look at unicorns, I think probably the first company or first investor that'll come up certainly is SoftBank, where they invest in really big bets. And this was actually a real slide from their quarterly presentation, where some of their bets fall in the valley and don't get out, and some make it out. And the number of those that make it out are obviously going to be a lot less than the ones that fail, because unicorns are the highest risk that you take on, along with the highest reward, right? They're dependent on funding, so they have a growth at all costs mindset. And anytime they raise money, it's all to fund growth. It's not to strive for profitability or to, grow more sustainably. And they're most often binary outcomes. So when you take this unicorn approach towards raising as much money as you possibly can to grow as much revenue as you possibly can, and figuring out the profitability on the other end, more often than not, you're going to find a binary outcome. Either it's a massive exit and you look like a genius, or the company fails. And that's been kind of the nature of the beast for the last several years. On the other hand, camels are real. You know, they're not always selling the future of the company. They're generating revenue. They're executing on the product that they built while continuing to innovate. Not real camels. This is a camel startup. They're efficient. They're able to survive in unforgiving environments, which I would certainly say that this is a similar one. Camel startups reinvest profits into growth. So instead of merely raising more and more money to continue growing, they're trying to find ways to drive efficiency and grow with those profits. And they still grow really quickly. It's just a more sustainable approach to managing your startup, which in theory should reduce the risk that you take on. So maybe you're not going for the $50 billion exit, but you're certainly going to be able to survive. And an amazing thing is when a startup's able to raise money on their own terms versus, hey, I'm running out of money in June of next year. I need this at whatever terms. It's a much better situation to be able to still grow really quickly, but be able to turn that off and survive when the going gets tough. In light of that, so the main takeaways are what I said. Shifting the mindset from growth at all costs to sustainable growth will be, I think, a big trend that you may have investors focused on over the next few months to a year. So one of the big ways that we encourage our companies to do that is prioritize efficiency drivers in your business. So we still want you to grow incredibly fast. We're not saying that it's time to become profitable next month. And it's really important to use numbers and metrics to help you get there. So here's one that I love. I hope this isn't too complicated, but I wanted to explain the concept to you all. This is from a guy named David Sachs, the COO of PayPal and a really great fintech investor and consumer investor. And it's a pretty simple revenue. It's a pretty simple formula. It's your net burn, so your revenue minus your expenses for that period of time, divided by the net new revenue that you're looking at. So if it's quarterly, quarter over quarter or year over year, it's a simple formula that you kind of have a bogey to shoot for, where if you are, I would say, at 2x or below with your multiple, you're in pretty good shape. So the story that I tried to tell, hopefully this is an easy enough example, is the company grew pretty quickly. They grew 13% quarter over quarter from Q4 to Q1, but they were spending a whole lot of money. They were very inefficient. Their net new revenue is far less than what they burned. Q2 comes along, coronavirus, they're trying to make better decisions to cut costs. The company doesn't grow very much. They only grow 4%, but they were able to cut their operating expenditures significantly to reduce that number to 2.4. And then hopefully they've kind of prepared the business. They've made all the cuts they need to do, and now they're ready to take off in the following quarter, and you start seeing those efficiencies grow. So this is an extreme example. I'm not saying this should happen this quickly, quarter over quarter, but this is an approach that you can consider in just gauging at a very high level how efficient you're being with your money, which will be really, really important as you raise more money down the road. And this is the slide that Jason was referring to. This is Wayne Gretzky, the greatest hockey player ever, and this is aptly him skating towards where the puck is going to be, not where it is, which is his famous quote. And even more importantly, he's wearing a Blues jersey. I think it's a really important mindset right now for startups to skate to where the puck's going to be. And Jason, maybe you can share kind of the ways that Ryvit is thinking about the future, what that looks like on the ground for you as you're skating towards where the puck's going to be.
Yeah. Happy to do that, Lucas. Foundationally, the scenario planning has become key. Still so much uncertainty, new information coming to light every day, every hour. So pulling in our planning cadence is the foundation for everything that we're doing right now. Keeping the conversation going, making sure that the leadership team all has the benefit of what our customers are saying, what our partners are saying, what we're all hearing, just making sure everyone has the most up-to-date information. So we have typically been on a quarterly planning cadence. We're planning our priorities, our objectives company-wide on a quarterly basis. Annual financial planning, obviously, with some quarterly updates. What we've done as a foundation for responding to this and skating to where the puck is going, as Lucas said, is pull that planning cycle into monthly and in a lot of cases weekly. So every week our leadership team meets to go through, okay, what were the results, whether it be new business, whether it be renewals, whether it be professional service fees, what were the results from the prior week. And we talk through our outlook, sort of our shorter term outlook, think a couple weeks to a couple months. A lot of that based on what we're hearing from our customers, which is another key aspect of how we're making sure that we're ahead of this, and that as soon as things do start to turn around, we're very well positioned to continue that type of growth rate that we're looking for. Then we're looking back on those decision points that we referenced earlier in the presentation, and comparing how we're tracking so far to those decision points, and then making the relevant decisions or deciding to stay the course. So that weekly leadership team meeting, where it's effectively a continuous planning process, is paramount to us being ahead of this. It might seem like a pretty big burden for companies at this early stage of their growth and of their business, but I think it's the most important thing for the entire team to be focused on right now is making sure that you're dedicating a good amount of time to this continuous scenario planning or continuous planning. Some other things that we've been thinking about and that we've been doing, we feel that there is an opportunity in all of this for our business, and there's a lot of opportunity that comes with this pandemic for other businesses as well. So rather than going completely on the defensive, which is what we've kind of been talking about to this point, make sure that you're thinking about, well, what's the opportunity here? And for technology companies, particularly technology companies that are helping businesses operate in a remote capacity or communicate better or be more efficient, whatever it might be, there's definitely an opportunity here. So for a tangible example, I would bring up a partnership that we have with SAP Concur, which is an expense and invoice management product. Construction companies are pretty far behind in terms of the use of technology. So a lot of construction companies out there are still using paper expense reports and still processing paper expense reports. So as some of the stay-at-home orders are lifted, but people are staying, they've got their 6 feet and there's fewer people in the office, it's probably going to be a lot harder to be passing paper back and forth in the short term and potentially even the long term. So there's an opportunity for us to promote that product as something that's going to help their team stay safe, but also be more efficient. Already talked about the planning cadence. So again, super important. Staying close to your customers. What we've been playing around with right now is we know our customers may need some flexibility in terms of their payment terms, maybe delaying some purchase decisions to see how the impact of the coronavirus shakes out. But we want to make sure that we're continuing to build goodwill with them. We want to make sure that we still have a strong relationship. So we're there to support them when they are able to move forward. So if there's anything that you as a startup can do for your customers that that may not require them to necessarily pay for that value right away, but maybe down the road, it's a reciprocal benefit to be able to do something like that. Without events taking place for certainly the foreseeable future, but potentially even the rest of this year. I know we have a couple of events in the fall that we're just not sure if they're going to happen, even though they're still 3, 4, 5 months out. So back to the scenario planning, back to sort of preparing for the worst, we're assuming that those may not happen. So one way that we're trying to continue reaching our customers, because in the construction industry, even though it's a massive industry, it's also a very small industry, in that people are very close. They talk to each other. So we've reached out to some of our existing customers and asked them to write a review for us on Capterra, so they can share their story with other customers that might be thinking about integration software. Continuing the transparency with the team has been huge for us and will continue to be huge for us. We have 2 weekly touch points with our team, where our leadership team talks about sort of what the priorities are for the week, how things have been going. We use it as an open forum for anyone on the team to ask questions. And something else that we do that's been really valuable in terms of understanding how the team is feeling, how the team is seeing the pandemic, how they're just feeling in general, because this is a very unusual time that a lot of us have never seen anything like this. We've been using it's called Tiny Pulse for quite a while now, that sends out a different question every week to our team and allows our team to anonymously respond to that question. And so we've been customizing questions around what's been going on with the coronavirus and the stay-at-home orders and mental health, because we want to be very close to our team and understand how our team is feeling throughout all of this. So we ensure that type of input goes into all the decisions that we're making and how we move forward. But those are some of the things that we've been thinking about. I'm sure there's a lot of other great ideas, but hopefully those are helpful for you as you think about how to skate where the puck will be.
Thanks, Jason. And just to wrap up really quickly, the last point, and I can't emphasize how important it is at this point, is to think ahead to your next financing now. So if you just raised your seed round, thinking about how long your runway is going to last and what your business needs to look like at that point before you raise that round, that's going to inform a lot of the decisions that you make along the way. Maybe whether you cut your runway even further to grow slower, but to last longer and reach the level that you want to get to raise your next round. And I would say, especially at this point, it's important to prepare for a rather unforgiving funding environment and hope to pass those expectations. I mean, I've seen the gamut. I've seen companies that have decreased their valuation by 40%. I've seen companies just kind of going along, raising at industry expectations. And I've seen some companies in spaces like digital health or healthy foods that are doing phenomenally as a result of this. But I think the smart thing to do is kind of expect revenue multiples to decrease, as well as more investor-friendly terms in your term sheets. So this isn't quite the venue for us to deep dive into this, but looking through a term sheet and getting familiar with the impact that liquidation preferences, participation, anti-dilution, various types of anti-dilution clauses will be really important. And just as an example, very quickly, revenue multiples have a really big impact on what a company is going to be able to raise at. And some of you are so small that, you know, you're just getting your business started, so you might not be judged on this multiple. But just as an example, someone that raised on a 10 times revenue multiple just a little while ago, let's say last year, if they're able to extend their runway to Q2 of 2021, it doesn't matter the time frame, they're going to have to double their revenue, their ARR, if they want to raise at a flat or up valuation. If their multiples compress to, you know, I just use 6 as an example, but that's a very realistic example of what you could start seeing. So really important to keep in mind and prepare for. So hopefully this was helpful. We tried to hit on, just so you know, the trends in the market, what we did immediately after COVID hit, and then how we're looking to the future, and Jason with some really specific examples of what Ryvit's doing and what your startup can be considering as well. So Nikki, I want to hand it to you and see if there are any questions.
Thank you so much.